There is a chart the Federal Reserve publishes only 4 times a year, and when it was released this past June, it came out with a hole in it. 19 people sit on the committee that sets the price of money for the United States. 18 dots appeared on the chart. The one that was missing belonged to the man running the meeting. This was not an error. It was not an oversight or a printing problem or a member out sick. The chairman of the Federal Reserve was asked where he thought interest rates were going, and he declined to answer. And I want to walk you through why that single blank space on an otherwise unremarkable government chart may tell you more about the next few years of your savings than any price forecast you will hear this month. Stay with me, because by the end of this, the missing dot, the gold price sitting near an 8-month low, and the fact that the world's central banks bought gold at the fastest pace in over a year while the price was falling are going to turn out to be the same story told from 3 directions. Before we go any further, I want to know who is in the room. Tell me in the comments where in the world you are watching from, and tell me honestly what you are holding right now. Gold, silver, cash, something else entirely. I ask because the answer to that question is not evenly distributed across the world. And the difference between how a viewer in Warsaw answers and how a viewer in Toronto answers is, as you will see shortly, one of the most important dynamics in this entire market. So put it below. We will come back to what your answers mean. Let us start with what that chart actually is, because the name is worse than the idea. It is called the dot plot, and the concept is simple. Every quarter, each member of the committee writes down where they personally think the benchmark interest rate will be at the end of the year. Nobody signs their name. The projections are published as anonymous dots on a grid. It is not a vote. It is not a promise. It is 19 educated guesses stacked on top of each other, so the world can see roughly where the institution's head is at. For most of the last decade and a half, that chart and the paragraphs of language that came with it served a purpose that had very little to do with forecasting. It was a management tool. The Federal Reserve had learned in the wreckage of 2008 that it could move markets without moving rates at all, simply by telling people what it intended to do later. Say that rates will stay low for a considerable period and long-term borrowing costs fall today before you have done anything. Economists call this forward guidance. In plain language, it is the central bank making a promise and letting the market do the work of enforcing it. That is the machinery that got dismantled in June. The statement that came out of that meeting was noticeably shorter than the ones markets had grown used to over the previous 8 years. The language that had signaled a lean toward future rate cuts was simply gone. The chairman described the new statement as a bit shorter, a bit simpler, and said it dispensed with some of the older language. And when the projections were published, his own dot was absent because, as he explained it, he had refrained from offering projections of his own consistent with views he had held for a long time. He encouraged his colleagues to keep submitting theirs. He would not submit his. Now, here is the part that matters, and I want you to hold on to it because everything else in this video connects back to it. When a central bank stops telling you what it is going to do, it has not stopped doing things. It has simply handed the job of pricing uncertainty back to you. For 15 years, the market did not have to guess. It was told, and an enormous amount of capital in bonds, in mortgages, in pension funds, in the retirement account you may be watching this from, was arranged around the quiet assumption that the guessing had been outsourced to a committee that would announce its intentions in advance. Remove the announcement, and every one of those positions has to be repriced against something the market has not had to face in a long time. Not bad news, not good news, just an honest blank, and the thing that gets more valuable when the blank appears. Historically, reliably, across centuries, is the asset that does not require anyone's promise to function. Which brings us to the paradox, and it is a real one. And if you own gold right now, you are living inside it. Gold reached an intraday high of roughly $5,595 an ounce on the 29th of January this year. As of the middle of this month, it has been trading around $4,000, near its lowest level since November of last year, roughly 28% below that January record. 28%. That is not a wobble. That is a serious, sustained, painful drawdown. And I am not going to pretend otherwise or talk around it, because you can see the number in your own account. And here's what makes it strange. Over that same stretch, the world's central banks were buying. According to the World Gold Council, central banks purchased a net 244 tons of gold in the first quarter of this year alone, the fastest quarterly pace in over a year. And the Council's projection for the full year sits at roughly 850 tons, which is more than double the annual average these institutions ran before 2022. The most informed, best resourced, least emotional buyers in the entire financial system were accumulating at a historic rate, and the price went down 28% anyway. If your model of this market is that central banks buy and therefore gold rises, that model just failed in front of you. So let us find out what is actually true. Start with the obvious force, because it is real and it is doing most of the damage. Gold pays you nothing. It sits there. So the cost of owning it is whatever you gave up by not owning something that pays. When interest rates rise or when the market simply becomes convinced they might, that cost goes up and gold gets less attractive in the most mechanical way imaginable. And this year, the expectation flipped back in March. The committee's median projections still implied a rate cut before year end. By June, that had inverted. Of the 18 who submitted projections, 9 saw at least one hike this year, 1 saw a cut, and the median moved up. Markets that had spent a year waiting for cheaper money were suddenly staring at the possibility of more expensive money. Then the Middle East pushed on the same lever from the other side. Fresh strikes on Iranian targets, retaliation against bases in neighboring countries, renewed questions about the Strait of Hormuz, and crude oil pushed to 1-month highs. Now, you might reasonably expect a shooting war near the world's most important oil choke point to send gold straight up. It did the opposite, and the reason is a chain most people skip. Expensive oil feeds into inflation. Inflation makes a central bank more likely to raise rates, not less. Higher rates make gold more expensive to hold. So the geopolitical crisis arrived at the gold market not as fear, but as a rate hike expectation. And it landed on gold as pressure rather than support. Traders currently put the odds of a September hike at roughly a coin flip. That is the honest explanation for most of the 28%. It is not a conspiracy. It is not suppression. It is arithmetic doing what arithmetic does. But here is what most investors miss. And this is where the story stops being about interest rates and starts being about something far more interesting. Some of the selling came from the central banks themselves. In March of this year, for the first time in 10 months, the world's central banks were net sellers of gold. Collectively, they let go of roughly 30 tons on a net basis in a single month. And the 2 names at the top of that list are the 2 names. This entire industry has spent 4 years telling you we're hoarding the metal. Turkey and Russia. Turkey was the largest seller of gold on the planet in the first quarter, reducing official reserves by around 79 tons. Russia has sold roughly 34 tons across the year to date, bringing its holdings to a little over 2,290 tons. Read that again, because I suspect it contradicts something you have been told repeatedly by people in my line of work. The 2 nations most frequently cited as evidence that gold is quietly replacing the dollar have been shipping gold out the door. So why? And this is the good part, because the answer is not the one that fear sells. Turkey did not sell because it stopped believing in gold. Turkey sold because the lira was under severe pressure. The war had triggered capital outflows, and the country needed dollars immediately. A large share of that reduction was not even an outright sale. It was executed through gold swap arrangements. Gold pledged to obtain dollar liquidity the financial equivalent of pawning the family silver with the intention of getting it back. Russia's selling maps onto fiscal strain under sanctions. Neither is a verdict on gold. Both are a nation reaching for the one asset in the vault that could be converted into dollars on a bad Tuesday without asking anyone's permission. Now, sit with what that actually means, because it is the single most important idea in this video, and almost nobody says it out loud. Gold did exactly what a reserve asset is supposed to do. We spend so much time describing gold as the thing that goes up when the world goes wrong that we forget what a reserve is for. A reserve is not a trophy. It is not a bet. It is the money you spend when the emergency arrives. Turkey held gold for years, precisely so that when a war broke out and the currency came under attack, it would have something it could turn into dollars without begging a foreign institution for a line of credit. The war came. Turkey spent the reserve. That is not gold failing. That is gold succeeding, and the price fell as a direct consequence of gold being useful. The people who sold their own holdings in March, because the headline said central banks are dumping gold, made a specific and expensive error. They read a liquidity event as a loss of faith. Those are opposite things. If you are finding this useful, take a moment to like the video and subscribe, because the second half is where the two lists come in. And the two lists are the part that changes how you read every gold headline for the rest of this year. Because while Turkey and Russia were selling under duress, a completely different set of institutions was buying. And their reasons could not be more different. Poland was the largest buyer in the first quarter, adding 31 tons to reach 582, working toward a stated target of 700. A program driven openly by security concerns on NATO's eastern flank. Uzbekistan added 25 tons to reach 416, which now represents roughly 87% of the bank's total reserves. 87%. That is not a diversification strategy. That is a worldview. China's central bank extended a buying streak that has now run for well over a year. And then there's a list almost nobody is looking at. Guatemala, Indonesia, Malaysia, Cambodia, Uganda, Kenya. These are not the names you see in a metals brief. Several of them are buying gold for the first time in their institutional history, or returning after decades away. The Council's most recent survey of central banks found 95% of respondents expected global official gold reserves to rise over the following year. The highest reading in the 8 years the survey has existed, and a record share said they intended to add to their own. So you have two lists running simultaneously. On one, nations under acute financial stress, converting gold into dollars, because gold is the thing that converts. On the other, nations with room to breathe, converting dollars into gold, because gold is the thing that cannot be frozen, defaulted on, or voted away. Both lists are behaving rationally. Both are telling you the same thing about what gold is for. And the net of the two, quarter after quarter, is still positive by a wide margin. The sellers are loud, concentrated, and temporary. The buyers are quiet, broad, and structural. Here is a piece of history that ought to be taught in every one of these videos, and almost never is. Between 1999 and 2002, the United Kingdom sold approximately 395 tons of its gold, more than half the national reserve. The sales were announced in advance, conducted by auction, transparent and orderly and entirely defensible on the reasoning of the day, which was diversification into interest-bearing currencies. The average price received was somewhere in the region of $275 an ounce. Gold has not traded at that level in more than 20 years. It is remembered now in the trade by a nickname I will not repeat out of politeness to the man it is named after, and it stands as the most expensive lesson a modern treasury has ever handed to the rest of us. A central bank selling gold is not a signal about gold. It is a signal about the central bank. The most sophisticated institutions on earth sold the bottom of a generational bull market in public with reasons that sounded excellent at the time. So when someone shows you a headline that central banks turned net sellers, the correct question is never, is gold finished? The correct question is, which central banks and what problem were they solving? Let me tell you about 3 people. None of them are real. All of them are common. Farron is 66, a retired Marine engineer, and he did something in 2019 that his family still occasionally teases him about. He moved a modest slice of his portfolio into physical gold, roughly 8%, because he had spent 30 years watching governments borrow, and he did not believe the arithmetic worked. And then, for the better part of 3 years, essentially nothing happened. Gold went sideways. His brother-in-law's technology fund doubled. Farron sat there being wrong. In public at family dinners for 3 years, holding an asset that did nothing, while everything else went up. I want to be precise about this because it is the part the promotional material always leaves out. Being early is indistinguishable from being wrong, and it lasts longer than you think you can stand. What eventually made Farron's position work was not insight. It was that 8% was small enough, that being wrong for 3 years did not hurt enough to make him quit. That is the whole technique. Size the position so that patience is affordable. Colette is 58, and she bought in January, not at the very top, but close enough that it does not matter. She had watched gold climb through the previous year, read that central banks were accumulating at a record pace, concluded that the case was overwhelming, and committed a meaningful sum near $5,400 an ounce. Then she watched 28% evaporate over the following months. Here is what I want to say about Colette, and I want to say it carefully. Her analysis was not wrong. Every fact she based the decision on was accurate and remains accurate. Central banks were buying. They still are. What she got wrong was not the thesis. It was that she treated a structural, decade-long argument as a reason to act on a Tuesday in January. A correct, long-term thesis tells you what to own. It tells you almost nothing about what price to pay this week. The gap between those two ideas is where most of the money in this market is lost. And Hollis, 55, who sold in March. He saw the reports that central banks had turned net sellers, felt the floor go out from under the story he had been told, and exited most of his position into the decline. Hollis was not stupid or panicky. He was doing exactly what a reasonable person does with new information. The problem was that the information he received had been stripped of its cause. Turkey sold because Turkey needed dollars. Nobody put that in the headline. Hollis reacted to a number that had been separated from its reason, which is the single most reliable way to lose money in any market. Now, why do intelligent people make Colette's mistake and Hollis's mistake so consistently? I want to give you something better than the usual answer about fear and greed, because there is a specific measured feature of the human mind that explains this moment better than any of that. In 1961, an economist named Daniel Ellsberg ran an experiment with 2 urns. One urn contains 50 red balls and 50 black. The second urn contains 100 balls, red and black in some unknown proportion. You win money for drawing red. Which urn do you choose? Overwhelmingly, people choose the first. Now play again. And this time you win for drawing black. People still choose the first urn. Think about what that means. If you believe the second urn was short on red, you should believe it is rich in black and switch. People do not switch. They just want the urn where the odds are known. This is called ambiguity aversion. And it is one of the most robust findings in behavioral economics. Human beings do not merely dislike bad odds. They will pay real money to avoid unknown odds, even when the unknown might be in their favor. Risk, we can handle. Ambiguity, we run from. Now go back to that chart with the hole in it. For 15 years, the Federal Reserve handed the market urn number 1. Here are the odds. Here is our intention. Here is our dot in June. The chairman handed the market urn number 2, and every instinct wired into every participant in that market says get out of Vern 2, pay whatever it costs, go somewhere the odds are printed on the side. That impulse is not a character flaw. It is a documented, measurable feature of how the human mind processes the unknown, and it is currently being expressed by trillions of dollars simultaneously. The reason this matters for you is that gold is one of the very few assets whose entire function is to be held inside urn number 2. It has no yield to forecast, no earnings to miss, no counterparty to disappoint you. It cannot be defaulted on, sanctioned, frozen, or diluted by a vote. It does not require you to know the odds, which is precisely why it feels so unsatisfying to own when everyone around you is being handed a printed forecast. And so obviously sensible in retrospect once the forecast turns out to have been fiction. Let me connect the last thread, because there is a piece of this that is quietly being built while everyone watches the price. The Monetary Authority of Singapore is moving to establish central bank gold vaulting services, part of a broader effort to build a gold hub in the city-state. And in the Council's own survey of vaulting preferences, the Bank of England remains the most popular location. But domestic storage now ranks second, and preference for the Swiss National Bank fell by half in a single year. Read those two facts together. The metal is not just changing owners. It is changing addresses. Reserve managers are increasingly choosing to hold their gold either at home or in a jurisdiction outside the traditional Western Alliance system, and they are doing it quietly in logistics and lease agreements years before it ever becomes a headline. Nobody vaults gold at home because they expect the next 12 months to be normal. And silver deserves a sentence of its own here because it is not simply cheaper gold. Silver carries two identities at once: a monetary metal with a history as long as gold's and an industrial input running through electronics, solar manufacturing, and a dozen technologies that did not exist a generation ago. That dual nature means silver is pulled by two ropes simultaneously. And when they pull the same way, it moves further than gold in both directions. In a year like this one, where the monetary case is intact, but the industrial cycle is hostage to an oil shock that is a genuinely different risk than the one you take on with gold. Related asset, different instrument. So let us bring all of it together and let us go back to that hole in the chart. We have established that gold is roughly 28% below its January high, and that the reason is largely mechanical, a market repricing from expecting cheaper money to fearing more expensive money, with an oil shock pushing in the same direction. We have established that central banks bought 244 tons in the first quarter, regardless, the fastest pace in over a year. We have established that the selling everyone pointed to as a crack in the story was a handful of nations under acute stress converting a reserve into dollars, which is the literal purpose of holding a reserve, and that history's most famous central bank gold sale happened at a generational bottom by an institution with every advantage. We have established that a second list of buyers, small nations who have never done this before, keeps getting longer. And we have established that the human mind is built to flee ambiguity. At exactly the moment ambiguity is most fairly priced, which leaves the missing dot. I have heard that blank space described as a communication failure, as arrogance, as a chairman refusing to do his job. I do not think it is any of those things. And I want to leave you with what I think it actually is. For 15 years, that chart offered a promise dressed up as a forecast, and the market accepted it. And an entire architecture of capital was built on the assumption that someone in that room knew. The blank space is the first honest admission in a long time that nobody does. Not the committee, not the chairman, not the analysts, not me. And that is the whole argument for owning a small, permanent, unexciting allocation to something that does not need a forecast to work. Not because a crisis is coming. Not because the dollar is finished, because it is not, and anyone who tells you they know the date is selling you something. But because the institution that spent 15 years telling you where things were going just stopped, And the correct response to a blank on the chart is not to find someone else who will fill it in for you. It is to own something that does not care what the chart says. Gold at $4,000 is not a broken thesis. It is what a reserve asset looks like in the middle of being used, priced by a market that briefly forgot the difference between a nation selling gold and a nation losing faith in it. So do not let the drawdown make the decision for you, and do not let a record high make it either. Look at the two lists. Ask which one you are on and why. Size any position so that being early for 3 years does not break you. Because if you are right about any of this, being early for 3 years is the most likely way it feels. Stay skeptical of everyone who fills in the missing dot on your behalf. And that includes me. None of this is financial advice, and every figure I have cited today is in the pinned comment, so you can check it yourself rather than take my word for it. The chairman was asked where interest rates are going. He looked at the question and left the space empty. After watching everything else in this video, I would suggest that blank space is not the least informative thing on that chart. It is the most honest.